Congratulations. If you're listening to my voice right now and you still have your silver, whether it's tucked away in your safe or locked in a vault halfway across the world, you have just witnessed something that financial historians will write about for the next 100 years. You have watched the single largest financial institution in the Western world, a bank that has spent decades suppressing the price of silver on behalf of the United States government, completely flip its position in a way that proves beyond any shadow of a doubt that the game is over. Ladies and gentlemen, Asian guy here known as John A.G. from Currency Archive, the emergency that we are talking about in today's title is not hyperbole. It is not clickbait. It is mathematical fact. J.P. Morgan, the bank that was caught, prosecuted, and fined nearly $1 billion for manipulating silver and gold markets through illegal spoofing tactics. The bank that held the largest naked short position in the history of commodities markets has just done the unthinkable. Between June and October of last year, they closed their entire 200 million ounce short position and flipped long. Not just long, massively long. We are talking about 750 million ounces of physical silver. That is not a typo. 750 million ounces. That is the largest physical silver stockpile ever accumulated by a single entity in the history of modern finance. It dwarfs the Hunt brothers' position from 1980. It represents nearly an entire year of global mine production sitting in J.P. Morgan's vaults. And the price you see on your screen right now, the number that says $31 or $74, depending on which exchange you're looking at, is a complete and utter lie. Let me explain exactly what just happened and why your decision to hold silver through the psychological warfare of the last few years is about to be vindicated in the most spectacular way imaginable. I know the comment section is probably on fire right now. I see the critics. I see the people saying, Asian guy, you told us silver was going to the moon, and look, it's volatile, it's bouncing around, nothing has changed. To those people I say this, you are watching the waves while missing the tsunami forming beneath your feet. You are focused on the minute-by-minute price action on a screen controlled by the very institutions that are now scrambling to survive. What I am about to show you today is not speculation. It is not theory. It is documented fact reported by major financial outlets, confirmed by regulatory filings, and validated by market behavior that anyone with access to the internet can verify. J.P. Morgan has abandoned their short position. The suppression mechanism that kept silver artificially cheap for 40 years has been dismantled. The architects of the manipulation have switched sides. They are now buying what they spent decades selling. And when the largest bank in America, a bank with direct access to the Federal Reserve's discount window, a bank that sits on the President's Council of Economic Advisors, makes a move this dramatic, this expensive, and this public, you need to understand what it means. It means they have seen the end game. It means they know that the paper market they helped create is about to collapse under the weight of its own fraud. It means that the physical shortage we have been warning you about is not coming. It is here. And it means that anyone still holding paper promises instead of physical metal is about to learn a very expensive lesson about counterparty risk. The first piece of smoking gun evidence that proves this is not just a trade, but an existential panic comes from the repo market. The repurchase agreement market, or repo, is the plumbing of the financial system. It is where banks go when they need overnight cash to meet their obligations. In a healthy banking system, banks lend to each other in the interbank market. The repo facility at the Federal Reserve is supposed to be the emergency room, the place you only go when you're in serious trouble. For most of 2025, repo usage was minimal, the market was calm, banks had plenty of liquidity. Then something changed. On Halloween of 2025, one or more undisclosed banks tapped the New York Fed for $51 billion in emergency cash. That is not normal. That is a distress signal. Fast forward to late December and early January of 2026. The New York Fed injected another $34 billion into the banking system through the repo window. In the span of just a few weeks, we are looking at $85 billion of emergency liquidity being pumped into institutions that are supposedly healthy and well capitalized. The timing is not a coincidence. Silver hit $84 per ounce in late December. It gapped up overnight. The move was violent, it was unexpected by the mainstream, and it triggered margin calls across the commodities complex. When you're short a futures contract and the price moves against you, the exchange clearinghouse does not wait for you to close your position gracefully. They call you immediately and demand cash to cover the risk. If you do not have the cash, they liquidate your position by force. J.P. Morgan reportedly sold their short position between June and October, but other banks did not. Citigroup, HSBC, and a dozen smaller institutions were caught on the wrong side of the move. They needed cash immediately, not next week, not tomorrow, same day. And the only place to get that kind of money on a short notice when your balance sheet is already leveraged 15 to 1 is the Federal Reserve. So they ran to the repo window, hat in hand, and borrowed tens of billions of dollars just to stay alive. Now, let me connect the dots for you, because the mainstream media will not do it. They will tell you that repo operations are routine, that this is just year-end window dressing, that there's nothing to see here. That is a lie. Year-end window dressing happens in the open market. Banks adjust their balance sheets to look healthy for regulatory filings. They do not tap emergency facilities for $34 billion unless they are in acute distress. The caps on repo lending were lifted in early December. The New York Fed, which had previously limited how much individual banks could borrow, removed those limits. Why would you remove limits on emergency borrowing unless you expected banks to need much more cash than the old limits allowed? You would not. This is a preemptive move. The Fed saw the margin calls coming. They saw the silver price spiking. They knew that if they did not open the floodgates, one or more major banks would fail to meet their obligations, and the entire derivatives complex would seize up. So they printed the money. They bailed out the shorts. Again. But here is the trap they have walked into. Every dollar they print to save the banks devalues the currency. Every bailout validates the thesis that fiat money is being destroyed to protect a system built on leverage and fraud. And every time they intervene to suppress a commodity squeeze, they make the physical shortage worse. Because while they can print dollars, they cannot print silver. They cannot conjure metal out of thin air. And the people who actually need silver to build solar panels, to manufacture batteries, to produce electronics, those people do not want dollars. They want ounces. And when JP Morgan closed their short and started buying physical, they sent a message to every other industrial buyer in the world. They said, the paper game is over. Get the metal while you still can. Let me explain how the futures market works. Because if you do not understand this, you will not grasp the magnitude of what is happening. When you sell a silver futures contract on the COMEX, you're promising to deliver 5,000 ounces of silver at a future date. You do not need to own the silver when you sell the contract. You just need to post margin, a good faith deposit that proves you can cover your obligation if the price moves against you. The system was designed to provide liquidity and allow hedging, but it has been weaponized. Banks like JP Morgan have sold hundreds of millions of ounces worth of contracts, far more than they could ever deliver, in order to create the illusion of supply and push the price down. It is fractional reserve banking applied to commodities. For years, this worked because most contract holders did not stand for delivery. They rolled their contracts forward or settled for cash. The exchange never had to produce the metal, but that dynamic is changing. Industrial buyers, sovereign wealth funds, and large investors are now demanding physical delivery. In December of 2025, over 12,000 contracts stood for delivery. That is 63.5 million ounces. The registered inventory on the COMEX, the metal available to satisfy delivery, is nowhere near that amount. The vaults are bleeding. JP Morgan, Brinks, Delaware Depository, all of them are seeing withdrawals. The metal is leaving New York and London and flowing east to Shanghai, to Mumbai, to Tokyo. This is not a short squeeze in the traditional sense. This is a physical run on the bank. And just like in 1933 when people lined up to exchange paper dollars for gold and the government had to close the gold window, we are approaching the moment when the COMEX will have to admit they cannot deliver. They will invoke force majeure. They will settle contracts in cash. And the moment they do that, the paper price and the physical price will decouple permanently. You have to understand what JP Morgan has done here. They did not flip long because they suddenly became silver bugs. They did not wake up one morning and decide to fight for sound money. They flipped because they ran the numbers and realized that staying short was a guaranteed path to bankruptcy. Let me walk you through their calculation. From June to October, silver was trading in the range of $28 to $35 per ounce. JP Morgan held a short position of 200 million ounces. That means for every dollar silver rose, they lost $200 million. When silver hit $40 in August, they were down over $1 billion. When it hit 50 in September, they were down several billion. At 60, they were underwater by $5 billion or more, and they could see what was coming. China announced export restrictions on silver in July. The Shanghai Gold Exchange premium, the difference between the price in China and the price in New York, started widening. It went from $2 to $5 to $8. That spread is an arbitrage opportunity in a normal market. Traders should buy silver in New York at 72 and sell it in Shanghai at 80 and pocket the difference. But the arbitrage was not closing. The gap was widening. That told JP Morgan everything they needed to know. It told them that the metal could not leave the West fast enough. It told them that China was hoarding. It told them that the physical market was tighter than the paper market reflected. So they made the decision. Cut the losses now while they still can. Close the short. And not only close it, but flip to the other side. Buy the physical. Become the whale. Control the supply. Because in a shortage, the entity with the metal has the power. They can set the price. They can choose who gets access. They become the market maker. JP Morgan spent decades as the hammer smashing silver down. Now they are the anvil, and everyone else is getting crushed against them. The data we are seeing out of the Shanghai Gold Exchange confirms this bifurcation. While COMEX silver trades around $74 per ounce, as of early January 2026, physical silver in Asia is clearing at prices between $78 and $130 depending on the form and location. In Japan, one of the largest bullion dealers, Tanaka, was quoting retail silver at the equivalent of $130 per ounce when you account for premiums and taxes. In Kuwait, reports put physical silver at $106. In South Korea, $97. These are not futures contracts. These are not paper derivatives. This is the price people are actually paying to take possession of a physical ounce of silver. The premium over spot has exploded because supply is drying up. Mints cannot keep up with demand. The United States Mint announced delays in silver coin production in November. Dealers are quoting 4 to 6 week wait times for standard products. And when you call them and ask why, they tell you point blank, we cannot get metal. The refiners cannot get metal. The mines are producing at capacity, but it is not enough. The deficit is structural. The Silver Institute projects a shortfall of between 95 million and 200 million ounces for 2026. That is the 6th consecutive year of deficit. You cannot run deficits forever. Eventually, the inventory runs out. And when it does, the price does not go up gradually. It gaps. It reprices violently because the people who need silver are not price sensitive. They need it to function. A solar panel manufacturer cannot build panels without silver paste. An electronics company cannot make circuit boards without silver. A defense contractor cannot produce missiles without silver. For them, paying $200 an ounce is acceptable if the alternative is shutting down the production line, so they will pay. And the moment that new equilibrium price is established in the physical market, the paper market becomes irrelevant. Your brokerage account might show silver at 74, but if you cannot actually buy an ounce at that price, then the price is fake. It is a reference point with no connection to reality. It is the COMEX claiming there is water in the reservoir while the pipes run dry. This is where the trap closes on the banks that did not get out in time. When JP Morgan closed their short and flipped long, they pulled the rug out from under their competitors. Other banks had been borrowing silver from JP Morgan through lease agreements. They would borrow the metal, sell it short, and profit when the price dropped. It is a classic carry trade. But when JP Morgan said, we want our silver back, those banks had a problem. They had already sold it. They did not have it anymore, so they had to go into the market and buy it back at much higher prices. And who was there waiting to sell it to them? JP Morgan, at a premium. This is the ultimate predatory move. JP Morgan bled these banks dry, forced them into margin calls, and then made them pay extortionate prices to cover their obligations. The repo spike we talked about earlier, the $34 billion from the Fed, that was the cash these banks needed to survive JP Morgan's backstab. They thought they were partners in the suppression scheme. They thought they were all working together to keep precious metals cheap. But JP Morgan saw the writing on the wall and cut bait. They threw their so-called allies overboard to save themselves. And the Federal Reserve, rather than let the system collapse, printed the money to keep those banks on life support. But life support is not a solution. It is a delay tactic. Those banks are zombies now. They exist only because the Fed is keeping them alive. And every time they need another infusion, every time the repo window opens again, it proves that the situation is not improving. It is deteriorating. Now let me address the inevitable question. If silver is so valuable, if the shortage is so severe, why is the price not at $500 already? Why are we still seeing it trade in double digits? The answer is simple. Price suppression through paper contracts, market manipulation through high-frequency trading algorithms, and most importantly, psychological warfare designed to make you doubt what you see with your own eyes. The COMEX can print infinite contracts. There is no limit to how many promises they can make. So when physical demand surges and the price starts to rise, they flood the market with paper supply. They sell 10,000 contracts in a millisecond. The algo sees a massive sell order and triggers stop losses across the retail market. Prices flash crash. Weak hands panic and sell. The banks then buy back the contracts at lower prices, and the cycle repeats. This is called the tamp down. It has been documented. JP Morgan was fined for doing it. Traders have gone to prison for it. But the fines are a cost of doing business. The prison sentences are limited to mid-level traders, while the executives walk free. The system is designed to allow this manipulation because the alternative, an honest price discovery process, would destroy the dollar's credibility. If silver went to its true value, it would mean gold is also mispriced. It would mean treasuries are mispriced. It would mean the entire fiat currency system is a house of cards. So the Fed and the Treasury have an interest in keeping the lid on precious metals. They will do everything in their power to maintain the illusion of stability. But power is not infinite, and their tools are breaking. The margin hike deployed by the CME group in late December was one of those tools. When silver hit $84, The exchange raised the margin requirement for futures contracts by 20%. This means that if you wanted to hold a contract, you suddenly needed to post thousands of dollars more in cash. For retail traders, maxed out on leverage, this was a death sentence. They got margin calls they could not meet. They were forced to sell. That selling drove the price down. Mission accomplished for the banks. But here's what they did not count on. The physical buyers did not sell. JP Morgan did not sell. The sovereign wealth funds did not sell. The Chinese industrial complex did not sell. In fact, they bought more. They saw the dip as a gift. And because the physical buyers absorbed the paper selling, the price did not collapse. It dipped from 84 to 74 and then stabilized. That $10 drop is nothing in the context of a 120% rally over 12 months. It is noise. But the banks were hoping for a 50% crash. They were hoping to shake out enough longs to cover their shorts at reasonable prices. It did not work. The diamond hands held. And now the banks are trapped again. They cannot push the price down without physical buyers stepping in. They cannot let the price run because they will face more margin calls. They are stuck in no man's land, bleeding capital, praying for a miracle. Let me give you the battle plan for the coming weeks, because this story is far from over. First, watch the $83 level. That is the recent high. If silver breaks above 83 and holds for more than a day, it signals that the suppression has failed and we are entering blue sky territory. There is almost no resistance between 83 and 120. The move could happen in 48 hours. Second, watch the Shanghai premium. If it widens beyond $10, it means the physical shortage is accelerating. It means China is paying whatever it takes to secure supply, and it means the decoupling between paper and physical is nearly complete. Third, watch the repo market. If the New York Fed has to inject another $30 or $40 billion in the next 2 weeks, it confirms that banks are in acute distress. It confirms that the margin calls are ongoing, and it confirms that the Fed is now the buyer of last resort for a commodity squeeze. Fourth, do not set stop losses. I repeat, do not set stop losses on your silver positions. The banks have algorithms that scan for clusters of stops just below support levels. They will wick the price down to trigger your stop, take you out of the position, and then rally it back up. If you're going to hold silver, hold it in a way that cannot be manipulated. Physical is best. Allocated storage is second best. Unallocated or paper products are a gamble. Here's what the skeptics will say. They will say, John, this is just conspiracy theory. You are seeing patterns that do not exist. JP Morgan is a sophisticated institution, and they make trades all the time. This does not prove anything. To those skeptics, I say, go look at the regulatory filings. Go look at the COMEX open interest reports. Go look at the delivery notices. Go look at the repo data published by the New York Fed. Everything I'm telling you is documented. JP Morgan settled a spoofing case and paid $920 million. That is public record. The New York Fed repo injections are published every week on their website. The Shanghai premium is visible on live price feeds. The inventory drawdowns at COMEX warehouses are reported monthly. None of this is hidden. None of this is speculation. The only question is whether you are willing to see it. The media will not report it because they are owned by the same institutions that benefit from keeping you in the dark. The financial advisors will not tell you because they are trained to keep you in stocks and bonds. The academics will not teach it because their research is funded by the banks. You are on your own, but you're not alone. Millions of people around the world are waking up to the same realization. The system is rigged. The currency is being debased. And the only way to protect yourself is to own real assets that cannot be printed. We are not just looking at a silver squeeze. We are looking at the unraveling of a monetary regime that has existed since 1971. And when Nixon closed the gold window, he severed the link between currency and hard assets. He gave the government the ability to print unlimited dollars backed by nothing but faith and credit. For 50 years, that faith has been maintained through military dominance, economic hegemony, and financial engineering. But the world is changing. China does not want to hold dollars anymore. Russia is buying gold and silver. The BRICS nations are building alternative payment systems. Central banks around the world are diversifying out of treasuries and into hard assets. And at the center of this shift is silver. Silver is the most undervalued strategic metal on Earth. It is essential for the energy transition. It is essential for defense technology. It is essential for electronics and computing. And it is in structural deficit. When a strategic asset is in deficit, governments do not sit idly by. They act, they hoard, they restrict exports. China has already done this. They have implemented the strictest export controls on silver in history. They are not letting it leave the country. They are stockpiling it for their solar industry, their military, their technological ambitions. And if China is hoarding, you can bet that other nations are watching and preparing to do the same. This is how resource wars begin, not with tanks and bombs, but with silent accumulation and strategic denial. JP Morgan saw this coming. They saw the export controls. They saw the deficit projections. They saw the geopolitical realignment, and they made the decision to position themselves on the winning side. They are no longer trying to suppress silver. They are trying to own it. And if you are holding physical silver, you are on the same side as JP Morgan. You are positioned for the same outcome. The difference is they are doing it with billions of dollars and you're doing it with whatever you can afford. But the math is the same. As supply shrinks and demand grows, price must rise. It is not a matter of if, it is a matter of when. And based on everything we are seeing, when is now? So here is my message to you. If you have been sitting on the sidelines, waiting for the perfect entry point, waiting for confirmation, waiting for the mainstream to tell you it is safe, you are going to miss it. The perfect entry was 5 years ago when silver was $14. The good entry was 2 years ago at $22. The acceptable entry was last year at $30. Right now at 74 or 80 or wherever it gaps to tomorrow, you are not buying at a discount. You are paying the market price to secure a position before the market breaks. And once it breaks, once the COMEX defaults, or China bans exports entirely, or the Fed loses control of the repo market, the price will not be accessible to the average person anymore. It will be $150, $200, $300 per ounce and climbing. You will watch from the sidelines as the wealth transfer happens in front of your eyes. The people who understood what was happening and acted will be positioned to thrive. The people who waited for certainty will be left behind. This is not financial advice. I am not a licensed advisor. I am a researcher, an analyst, a commentator. But I am also someone who has watched this market for years, who has studied the history, who has read the filings, who has connected the dots, and everything I see tells me that we are in the final phase. The suppression mechanism is broken. The banks have flipped. The Fed is trapped. The physical market is decoupling. The East is taking the metal. The West is playing with paper. And when the music stops, the people holding real assets will be the ones left standing. JP Morgan soaring the silver market is not just a headline. It is a signal. It is a flare shot into the night sky by the largest bank in the West saying, we are abandoning the old system, we are securing hard assets, and if you are smart, you will do the same. The emergency is real. The shortage is real. The deficit is real. The repo injections are real. The Shanghai premium is real. The margin hikes are real. The manipulation is real. And the opportunity for those who see it clearly and act decisively is real. We are living through a once-in-a-century shift in the global monetary order. Do not waste it by sitting on the sidelines, hoping for a dip that may never come. This is John A.G. from Currency Archive. The game is over. The banks have flipped. The metal is moving east. And if you're still holding, you are on the winning side. Stay strong. Stay informed. And whatever you do, do not let them shake you out now. Like, subscribe and share this video with anyone who needs to hear the truth. We are going to win this.